So Mark Carney has just unveiled his master plan to rescue the UK economy. At its heart is a revolution in monetary policy. In the past, we had inflation targeting. Quite simply, the bank would hike rates if inflation it thought was going to get out of control and cut rates if inflation it thought was going to be too low. In theory, we retained that, but in addition, Carney's added something called forward guidance. So what does this mean in practice? Well, Carney is basically saying he doesn't want to hike rates until unemployment falls to 7% or below, and even then he might not increase interest rates. There are three caveats to that, which means that he might have to change his mind. The first is if the bank thinks that inflation 18 months ahead is going to be too high. The second is if inflation expectations cease to be anchored, in other words, if people start to worry about inflation. And the third is if there are risks to financial stability as determined by the Bank of England. So that's really the idea. And if he's going to take at least 3 years for unemployment to fall back to 7%, it's about 7.7% now, and he thinks there will need to be 750,000 net extra jobs added to the UK economy. I've got some problems with all of this for a number of reasons, but before I explain why, let me tell you what the theory is behind this kind of forward guidance. The theory is quite simple. It's that there's actually quite a lot of spare capacity in the UK economy. The idea is that a lot of office space is empty, a lot of factories are not working flat out, and there's a lot of unemployment quite clearly. And the thought is, if you boost demand, if you continue to boost demand by using loose money, then what you're going to get is a response from supply. In other words, companies are going to produce more, and the economy will get out of its rut and grow in a sustainable, non-inflationary fashion. I don't really think that's going to work out that way. First, I've got a problem with his unemployment forecast. I think it's going to be much quicker for unemployment to fall that much. The economy is actually doing pretty well at the moment, and a lot of it is due to unsustainable bubble-type factors, the fact that the government subsidising credit and so on. But nonetheless, I think unemployment is going to fall faster. That's also the view of the market, which is why they don't really believe the rates are going to stay on hold for 3 or more years. So that's the first big problem. Second big problem is I don't think unemployment is a good measure of spare capacity in the economy, and I actually think there is not at all as much spare capacity as Carney and his friends believe. I think actually that the credit crunch and the recession destroyed a lot of capacity. A lot of previous investments have been rendered worthless. Imagine a 60-year-old computer bought at the height of the bubble. Well, it's worth nothing now. It doesn't help you anymore. There's no more spare capacity. It's been destroyed. There was a lot of bad investments that have had to be liquidated. So I'm not convinced there's much spare capacity, which means I suspect that lots of loose money will actually mean that demand will grow too fast for supply to cope. That's going to suck in lots of imports. That's going to create inflation, push up consumer prices, and that's also going to create more bubbles, perhaps even more in the goods markets and also especially in property. So I'm not convinced by Carney's policy at all. Yes, there's going to be more growth in the next couple of years. Yes, that's going to be good news for George Osborne, the Chancellor, but sadly, I fear that it will all end in tears. Rates should be going up today. They're not. When they eventually go up to cope and deal with the extra and excessive demand in the economy and the growing inflationary pressures, I fear that the shock would be really, really bad for the UK economy and a lot of people won't be able to cope. So I'm pretty pessimistic about the medium-term future for the UK economy.